Hello and welcome to the Fat-Tailed Thoughts podcast. I'm your co-host, Stephen Dickens, and I'm joined as always by my dear friend and now colleague, Jared Klee. Hey Jared, welcome to the show.
Good morning, Stephen. How are you?
Yeah, very good, very good. How's things with you?
Having fun. So
Yeah?
just for listeners' context here, so I joined as Stephen is an analyst, senior analyst over at Futurum Research, and I joined as analyst in residence covering Web3 and crypto and the metaverse and related stuff. So very, very exciting.
Yeah, it should be good. Glad to have you on the team.
It'll be fun.
Yeah.
I'm already enjoying it. Article 1 is published and many, many, many more to come.
We'll put that in the show notes for everyone just to sort of get that out there. So, if you're new to the Fat-Tailed Thoughts podcast, we cover the makings of markets, money, crypto, fintech. And this week we're on to what's been going on in the nickel market. Not a market many people track. I don't know whether there's a lot of people who listen to the show who are trading on the London Metal Exchange. But I think going back to a sort of continual theme that's discussed on these shows, how these markets are structured, shining a light on some of the smaller markets. We've shined lights on sneakers, on watches, on startup equity. So in the same theme, this week we're talking about the London Metal Exchange, what's been going on with nickel over the last few weeks. So Jared, just get us orientated, talk us through here what we're going to cover in the show and really get the listeners and the watchers orientated here.
It's been an absolute mess. It started earlier this month, and it follows on from real organic stuff. But this is helpful because it's not just, we're not just talking about futures here. We're not just talking about metals. Really, we're talking about the fundamentals of how markets work and the control the exchanges have over the functioning of those markets. And it happens that nickel specifically is one where we've seen a whole bunch of shenanigans recently. So the backstory here, nickel trades in the market alongside a bunch of other commodities. In a couple of weeks ago, March 6th, 7th, 8th, trading went through the roof. Prices had fluctuated about 20% over the last 6 months, and in 2-3 days, the price of nickel went up a couple 100%.
And so let's just provide some context of why that happened. I think most of our listeners will be able to guess, but obviously Russia, Ukraine happened at around that same time. So just join the dots up for us.
Yeah, so we'll go all the way. We'll go a little bit deeper here. So the majority of the world's nickel, rather the largest exporter of nickel in the world is Russia. That even that understates their real role because the Nornickel, the company that does the majority of the exporting, actually has an even larger percentage share of grade A nickel that's used in car batteries and used elsewhere. So especially as we talk about like the rise of electric cars, it's a major component there. With what's going on in Ukraine, with the Russian invasion of Ukraine and the ongoing sanctions against Russia, there's been real fears and fully justified fears that the nickel market would get disrupted if a major producer, about 15% of the world's nickel, suddenly gets removed from the market. You're going to see demand spike you're going to see rather price spike at a time when demand is already elevated because of the ongoing production of car batteries and so on. Well, what happens is that in a futures market, you have some people that are long, meaning they're betting on the price going up, and you have other people that are short. They're betting on the price going down, and they make money depending on the direction of the price. More than a couple of market participants were short nickel in significant volumes. There was one market player who, in fact, had shorted nickel to the tune of more than 2.5 times the total volume stored in the London Metal Exchange warehouses. So tremendous volumes of short. What that can set you up for is what's called a short squeeze. So someone will say, if you've shorted something, you know that when it comes due, they have to go and pay it. And in the commodities world, you don't always just get to pay in cash. Often you actually have to physically deliver the underlying good, the nickel. Well, if you've shorted more than 2.5 times the amount in the warehouses, good luck getting access to supply. It's a hard problem.
You better get digging, basically.
Real fast.
So there's some parallels here. We've obviously had another short squeeze happen in the stock market with what recently happened with GameStop. We saw Robinhood stop trading of GameStop. I know structurally different, and we talked about this before we got on the show, but I think there's some parallels and maybe some illustration that we can draw, two markets in stopping. Talk us through some of the differences, because I think, as we discussed before the show, that's illustrative and will be good for the discussion here.
So two totally different, again, right point, both short squeezes, two totally different outcomes. So in the case of Robinhood and GameStop, we saw a short squeeze, meaning a bunch of people were short GameStop. Actually, in fact, there were more shorts than there were shares outstanding, which means you end up with this musical chairs game and somebody's going to be left outstanding. The way a short squeeze gets put on is a bunch of people bid up the price of whatever is short. As you bid up the price, the people that are short, they've done it on margin, meaning they've taken out loans against it. As the price goes up, their potential losses grow. They're required to put up more and more collateral, more and more margin in order to cover the potential losses. Well, at some point they yell uncle and they sell the thing. Well, they go and buy back the thing in order to cover their short. When they do that, it drives the price up further. So you end up with this spiral until either all the shorts are out or until all the longs have taken their gains and removed themselves from the market. GameStop, we saw a short squeeze. The price went through the roof. Robinhood is a broker-dealer. They are not an exchange. So Robinhood, because a bunch of people had shorted GameStop through their platform, was required to put up margin on behalf of those short sellers at the exchange and more specifically at DTCC, the underlying settlement system. They were overnight required to put up, if memory serves, $4 billion of margin, which they simply didn't have. So rather than go out into the market, rather than shut down, they said no more trading GameStop while we figure our stuff out. That is not an appropriate response. That is Robinhood looking out for itself at the expense of its customers. Now, if we go downstream, the exchange itself, exchanges will halt trading from time to time. That can be a very healthy way for markets to function.
This is the classic circuit breaker that we've heard of. Something's gone wild. Markets stop for big events that happen. 9/11 closed the markets for a while. Stopping of markets is not usual, but it's not unprecedented either, I think, is your point.
They're there precisely because when major events happen, that major event could be real in the case of 9/11. It could be that some major press announcement got released that was unexpected. It could be that someone declared bankruptcy. Or it could be that somebody made a massive fat finger trade and is just blowing the price way out of proportion in a short period of time. Those circuit breakers are there so that everybody, all of the market participants in that asset, are all subject to the halt at the same time. It allows the market to reset. It allows whatever the new price information, relevant price information to be incorporated, people to re-get their bearings and then go, okay, now we can return to normal market functioning. That is a healthy move. What we saw in the nickel market was not. We saw normal functioning of markets. Yes, the price went up 250% in 2 days, which is wild. I mean, nickel had moved 20% in the prior 6 months and moved 250%, more than 10x that in 2 days. But throughout the entire period, the market kept functioning normally, meaning for every buyer there was a seller, the market was liquid, trades were going through, not failing. We were seeing all of the normal healthy market functionings. At the end of the day, London Metal Exchange said we're going to halt trading. Fine, that's their prerogative. And then they said, oh, and by the way, all of the trades executed in the last 24 hours, we're going to cancel.
So let's maybe unpack two parts of that. So the question one, why did they not just stop? So you see the market go crazy, 250% increase of anything traded on an open market is crazy. Why did they not just watch that and go, whoa, we're just going to pause nickel trading for 24 hours, 36 hours, whatever period of time, and let the market. If it was on that trajectory, they could see that information in real time. Why did they just not go, let's stop it? Then the second question, which is a bigger question and probably where we want to spend some more time, why did they then go and unwind the trades of the 24 hours? So maybe just why they didn't stop it first and then why they unwound it second.
So as the price was increasing, and yes, it was increasing dramatically and rapidly, that is normal, healthy market functioning. The prices happen to move a lot, but the core market functioning, meaning we're not seeing huge players come in and just dump on the market. We're not seeing trades fail to go through. What we saw is an organic change in the supply, namely Ukraine and Russia. Russia perhaps coming off. A bunch of players in the market said they'll short it. Fine, that's their prerogative. Other players in the market said, I don't think they're going to be able to cover those shorts, so they started driving up the price. It was a short squeeze, but that's a totally inappropriate function of the market. And by the way, we've seen many short squeezes in the past in nickel and other markets as similar types of fluctuations happen, and folks simply got out over their skis in terms of the size of the positions they were taking. The reason you would cancel trades, which by the way, it is in the books, there's nothing illegal here. London Metal Exchange has in their books the right to roll back trades, and most settlement systems do as well. There are times when that's appropriate. Trades failed to go through. Trades were accidental. I put too many zeros on there. Put the decimal place in the wrong place.
And we talked about this on a previous podcast. You talked about the structure of the New York Stock Exchange back in the 1929 crash, and how that 25% of trades didn't go through. We've talked about that on previous podcasts.
That was during the paperwork crisis in the 70s. 25% of trades failed. So they started putting halts in place, and they shut down the stock exchange for a day and so on. This is different. These trades were going through. There were buyers and sellers. They were healthy, normal market functioning. What happened is a bunch of people took huge losses because they're out over their skis, and London Metal Exchange stepped in and basically said, we don't think you should take those losses, so we're going to bail you out. Now, that's wildly inappropriate. The role of an exchange is to match up buyers and sellers and to create a market, not to pick winners. And in this case, they rolled back $4 billion of trades. $4 billion of trades, about $1.3 billion in profits, and simply said, you know what? Good work. Congrats on making the right trade and the right bet. But we like those people better on the other side of the trade who took the losses, so we're just going to come in and bail them out.
And
it's ridiculous.
You do a good job in the letter of explaining, because there's some things in what you just said. They picked winners. We like you people more than we like the other people. There was a really good explanation of why that is, and I think that's probably the pivot to the next section. Why did they make that choice? Because, as you say, this is an exchange that's been going on over 140 years. It's the biggest metal exchange in the world. It's where commodities like this get traded. This is not a decision they reached lightly. Why did they do it? And I think, as I say, you broke this down in the letter, and we'll put that in the show notes, but add some colour commentary here.
So I think, but before we get there, we have to hit on a little bit like what is a futures contract, like what are these people trading, because it's fundamental to why these people are in the market, how this market works. Which at its most basic, a futures contract is an agreement today to go exchange some good in the future at a price we agree on today. So Stephen, you and I could say if we were trading corn futures, you and I could say I'll pay, or wheat futures, I'll pay you $10 a bushel in what are we in? We're in April. So in June I'll pay you $10 a bushel, and we'll do it for 100 bushels, and we'll say great. And we can choose to settle in wheat or in cash, meaning that when we get there, if it's $12, one of us pays the other either, again, in more wheat or more cash, and the other way, if it was $8 rather than 10, the trade goes the other way. This is absolutely critical to how our markets work. If let's say that you're a baker and you have exposure to wheat prices, you're doing massive baking. You have exposure to wheat prices because it's a fundamental input in flour. You don't just want to take the risk that it's a bad harvest this year and the prices go crazy come when you need the stuff. So you're willing to make that trade now to get price certainty in the future so that you know your cost of inputs when you get there and you can keep running your business.
And the flip side goes for the farmer. They've got to buy next year's seed. They've got to pay the wages. They've got to put fuel in the tractors. They've got a bunch of monthly expenses that have got to go out. So some price certainty of, I know I'm going to get my $10 a bushel, gives them the ability to plan ahead and run their business. So it's beneficial for both sides of the trade, the baker and the farmer here, but to have some price certainty. Yes, the baker may make a little bit more if they were to wait, and yes, the farmer may make a little bit more if they wait, but that price certainty is exactly the reason why they're making this trade in advance of the actual trade.
Right, and the farmer and the baker are in the business of farming and baking, not betting on the price of the inputs and the output. So that they are quite literally, they're isolating that price risk, so instead they can focus on their core competencies, their core business. Now, there are other players in the market, typically financial players, hedge funds and banks and so on, that will go in and bet on the direction of price. And they'll take the other side of that trade. In their case, they're looking to make money by betting on the direction of price. That is their competency. In return, they're providing capital to these markets so that the baker and the farmer and so on have somebody to trade with. It's, again, this is fundamental 101 of markets. This is a healthy exchange. Someone with a lot of capital comes in and provides it. Somebody who needs price certainty is willing to pay for that, and they both benefit more than they would if neither participated. What I actually described could be futures or could be called forward contracts. And let me just detail the difference. A forward contract is typically not executed at an exchange. It's executed one-on-one. It's a custom contract. We can choose the amounts, we can choose the terms, the amount of margin. We can basically do whatever we want. And it's one-on-one between typically somebody who needs that contract and a big, big capital provider, more often than not a bank. Mm-hmm. So JP Morgan's a major player here. Citi's a major player here. It's the big boys. A futures contract is executed at an exchange. And the major, major role of that exchange is it eliminates counterparty risk. So if Stephen and I are executing a futures contract again against wheat for 3 months' time from now, if we execute it on an exchange, what actually happens is there is no contract between me and Stephen. What happens instead is there's a contract between me and the exchange and an offsetting contract between Stephen and the exchange. The exchange itself steps in and takes on that counterparty risk. So in the event that I go bankrupt or in the event that Stephen goes bankrupt, the other side of the trade doesn't suffer it. The exchange takes that risk. There's a bunch of other functions that come in with that. The exchange manages the daily margin requirements. So if I have to put up 10% of the total value of that trade, and then the price goes wild, and then they're like, hey, you've fallen below 10%, put up more capital. Stephen doesn't have to call me up. The exchange is managing that interface. Now, that creates a problem for the futures exchange, which is it's now on the hook for a lot of stuff. So what it does instead is, and this is an old model. The London Metal Exchange is 140 some odd years old, but this model predates the London Metal Exchange. The exchange has a membership model and an insurance policy. So the membership model is there's only a very small number of parties that actually get to trade with the exchange. So instead, I have to trade with one of those members, like a JP Morgan, and the JP Morgan in turn will trade with the exchange. So JP Morgan takes my risk and tries to then offset it in the futures market. The insurance policy is funded by those very members. So meaning the exchange has a bucket of money sitting around that's filled up by the members that are allowed to trade there. And in the event that one of them fails to go through, the exchange is made whole out of that bucket and then they refill it from the still standing members. That is a really powerful model because when it works right, it can fail, and we'll get to this. When it works right, it aligns incentives. The members only allow new members in that they know are going to be money good. They're not going to default, because if they do, they're on the hook for bailing them out. They're going to execute trades with counterparties that they know they can trust. It's a really, really healthy alignment of incentives. What we had here, though, and this is where stuff gets a little messy, is when all of them are going to take risk at the same time, when all of them are going to take a massive loss at the same time, they can move in cahoots with each other. Right word is cohort, but I'm going to call it cahoots with each other. And basically as a block decide, none of us are going to take those losses. Instead, you, Mr. Trader, you, whoever, are going to take the thing, and we're going to change the market structure.
And this comes back to the question I asked a few moments ago. They decided to pick winners and losers because those winners and losers, the losers in this case, were the 45 members who were backstopping this market. They were in cahoots to go, us as a group of 45 are going to be the losers on this side. The hedge funds that have decided to take the opposite side of this bet are going to be the winners. They're not active participants that are taking risk in this market. Therefore, we're going to make some decisions around whether we back those trades off or not. So, I mean, crazy times about the structure of what is a very, very old market in its current form, 140 years old, goes back even further than then. Talk us through the sort of mechanics of what actually happened in that 24 hours.
So the company that shorted nickel to the tune of 2.5 times the amount that was in the exchange's warehouses is a Chinese company called, and apologies if I butcher the name, Tsingshan Holding Group. And they're a massive Chinese company, steel manufacturer, nickel miner. They've got a whole series of subsidiaries. What makes them particularly interesting, so nickel is a major input into steel manufacturing, which again goes into cars alongside the batteries. The quality of nickel that they produce out of their mine is of a different quality than what's traded on the exchange. So even though they were on the exchange shorting the future price of nickel, they could not use the nickel they mined to meet the delivery requirements, which meant that they would have to go out into the market and buy other nickel. The nickel they produce is perfectly good for the steel that they use it in, but not good for meeting the futures contract requirements. So Tsingshan made a massive series of shorts. Some of those were done through its party on the futures market, a party called CCBI Global, another Chinese company. Part of it, in fact, the vast majority of it, was done in forward contracts with a whole series of banks, the biggest of which was JP Morgan. So where this gets really interesting is that meant that when they were short, in theory, the exchange was only exposed to a small amount of it if they couldn't meet the trades. Well, the problem was that many of the exchange's members, among them JP Morgan, was taking a loss. If Tsingshan couldn't meet their obligations, was going to take a loss because the insurance fund at the exchange, and they were going to go take losses on the forward contracts that they had made one-on-one outside of the exchange. That creates really nasty pressure on the exchange, because with JP, and I'm not pointing a finger at them, they're simply the largest. It was JP Morgan, it was Standard Chartered, it was BNP Paribas, there were a number of them. They're taking losses on the exchange and off the exchange. They have a massive incentive to figure out how to cover those losses. And the easiest way to do that is to have the exchange simply say, all those trades on the futures market, we're just going to wipe those off.
Yeah, the best way to get rid of
whatever
losses.
Those losses were, they're just gone now.
Yeah, the best way to get rid of losses is to just not have them at all.
And it's why I called it this week's letter Return of the Futures. The London Metal Exchange basically went back in time and went, well, what if we just didn't make those trades? Well, then we wouldn't have the losses. They just wiped them from the books. Now,
this is like the New York Stock Exchange just forgetting that yesterday was Thursday, a whole day's worth of trading. It's now Friday. It's basically Wednesday again.
It's wild.
Yeah,
it's wild. And where I don't want to get conspiracy theory-ish here, but it's important to understand the players, the actors, and their relationships. So
that was one of the questions I was going to ask on behalf of the listeners. You mentioned two big Chinese players here. My eyes are squinting for those of you watching on YouTube. Is there a geopolitical angle here? Is it just purely big companies ganging together and being in cahoots? Did somebody lean on somebody? You know what? There's a obviously quite bizarre geopolitical landscape going on at the moment. Is that a factor here?
So I want to be very clear before I get into this, because
sorry for putting you on the spot with that one. By the
way. It's the right question, but I need to be careful and be very clear. What I'm going to walk through, the relationships are well established in public. Whether we do not yet have any evidence, and I don't know if any evidence existed or whether it happened, whether inappropriate pressure was put on any of the companies by any other company or state. So I'm gonna outline the relationships and
I see
for
a
the
career
listeners
in politics ahead of you, Jared.
For the listeners, you can infer whatever you would like to infer from this. So we already said Tsingshan is a major Chinese company, steel producer, nickel miner. CCBI Global is their member at the London Metal Exchange alongside JP Morgan, BNP, Standard Chartered, and about 42 or so other companies. When Tsingshan can't meet their obligations, CCBI is on the hook. If CCBI can't meet their obligations because Tsingshan's going under, London Metal Exchange is left holding the bag. In that model, the other banks then, through the insurance fund, bail it out. London Metal Exchange itself is not independent. A couple of years ago, it was bought up by the Hong Kong Exchanges and Clearing. Hong Kong Exchanges and Clearing is another Chinese company. It's the major organization responsible for exchanges and clearing in China. Both CCBI Global and Hong Kong Exchanges and Clearing bank at China Construction Bank, which is just a massive, massive entity. It's massive because it is a state-owned entity. Hong Kong Exchanges and Clearing is directly regulated by virtue of their function in the financial world, directly regulated by the Chinese financial regulators, who are also responsible for China Construction Bank. When we look at this, if we roll this whole thing up, the losses that Tsingshan was taking that eventually would have gone through the system would have hit two different sets of parties. One, it would have hit the JP Morgan, Standard Chartered, BNP Paribas, who are members of the London Metal Exchange, but had all these forward contracts on the side. The other player who was going to take massive losses was China Construction Bank. Ultimately, they were basically on the hook for all of Tsingshan. They didn't know it at the time, but by virtue of all these interrelated parties, when one goes under and the next goes under, the next goes under, eventually it's sitting on capital that was extended by China Construction Bank. So we don't have any evidence that pressure was put on by any single party or any group of parties to roll back these trades. From all we know, it was London Metal Exchange unilaterally made that decision. What we do know is that if you magically rolled back all these trades, all of the parties involved that are directly and indirectly borrowing money from China Construction Bank and are directly or indirectly regulated by China, they're all made whole. And the only person left out in the cold or group of people are the traders in the market that had made the right bet but are otherwise completely unrelated to everyone else we're talking about. So it seems that there is a massive incentive from a couple of actors to have done this, even though we have no evidence. And I will let everyone else make their own conclusions about how this went down.
I think we're going to, so we have the person who lost. So we've talked about the winners in these 24 hours worth of trade being erased. The losers that the trades didn't happen have got very, very deep pockets and are very, very upset. That normally leads to only one conclusion. I'm going to sue somebody with my very deep pockets because I don't really care whether I win or not. I just want to make a stink. Is that what you foresee as the next obvious outcome here?
Yeah, it doesn't take a lot of analysis from me on this one. So Cliff Asness, Cliff is as brilliant a person who's ever existed on Wall Street. He is a academic mathematician by trade, moved into the Wall Street world, has built two absolutely storied firms, the most recent of which is AQR. Started out as a hedge fund, is now a broader investment manager. They manage $143 billion, and he has done wonderful work for his investors. I mean, he's been wildly successful over many decades. He is also not one to keep his mouth shut. They have a group within AQR that's active in the metals market. They've a whole series of quotes in the news, but I'm just going to read you one of his tweets as this was all playing out. This was on March 10th. Quote, "And the cheaters win. London Metal Exchange, please note, I'm accusing you of reversing trades to save your favored cronies and robbing your non-crony customers. Everyone who trades should know what you did. You got lawyers. I'm ready. Bring it, slime balls." Yeah, guy's not pulling punches.
There's a lawsuit coming, and I think there'll be some more discovery of what actually happened that goes on in public court by the looks of it.
Agreed.
So, summarise us up here. We're 2 or 3 minutes over, as we always are, listeners. I fail every week to keep Jared to 30 minutes as we set out as the objective, but summarise us up and bring us home here.
So this is a really, really good lesson in market functioning, where control sits and where it can go wrong, and what the consequences are. So AQR is one of many market participants, but even they, and Cliff has been open about this, simply didn't expect an institution of the longevity, of the quality, of the upstanding nature of London Metal Exchange to pull a move like this, and yet they did. And again, we'll have lawsuits, but it's well within their rules. I mean, they're explicit in their rule book. Basically, at will, we can roll back trades, and it's not a trigger. It's not a lever they should be pulling, but they did. If someone like Cliff and a player like AQR can get blindsided and screwed over in this regard, it's a really important reminder for all everyday people like you and me and our listeners who are active in the equity markets and other markets that, yes, most of the time it works, but always keep your eyes open. There are rules underneath this that often don't come to light until something goes bad, until someone abuses the system. That, yes, what you think is quote-unquote a fair playground may in fact not be. And more often than not, it won't be exactly when you need it to be. Now, a reminder for the exchanges and the other big participants, this has real consequences. So London Metal Exchange has the lowest open interest it's had in 30, 40 years now. Open interest is how many people are willing to buy and to sell on the exchange. It fell 15% basically overnight in the nickel market. It fell close to 10% across all of their stuff, and it's continued on a downward trend since all of this went down. Now, right now, there's no major competitor to London Metal Exchange, But my guess is there are a whole bunch of small players who are moving in or putting their hands up and going, we won't abuse you traders. We won't abuse you bakers and farmers and so on. Why don't you come trade here? And I wish London Metal Exchange the best, but it takes years and years and years, decades to build up the type of trust they have, and they've in a single night torn it back down, and that is not going to come back quickly.
Yeah, great way to summarise this up, I think. You've been listening to the Fat Tailed Thoughts podcast, where every week we talk about the workings and makings of money, fintech and crypto and the markets. We'll see you next week for another episode. Please, in the interim, click and subscribe and click the notifications buttons so that you get notified when every episode drops. We'll put the newsletter in the show notes, and we'll speak to you next time. Thanks very much for listening.